Thanks very much for inviting us to be here. I think when Kath asked us to come and present, it was sort of off the back of a sort of smaller session that we did for her and John Eden, probably about 2 or so years ago now, before the pandemic. As I'm sure many of you feel as well, time has flown by quite quickly, but it's really good to come back here and speak to you all and hopefully help answer some of the questions that you might have already, but also to sort of answer any fresh ones either during the session or at the end with questions. So what we've called today's session is, what do insurers think about Huntingtons? Because I think from our engagement with Kath and John and your respective associations, that's often what the sort of the thrust of the question is really. And just to really, before we get started and tell you who we are, I just wanted to sort of cover off, I suppose in some ways, what we really want to get across today, and then just sort of tell a little bit of a story about insurance as well, if that doesn't sound too dull. And so really, I think what we want to get across, along with some other bits and perhaps some bits of detail, is that a family history or a gene for Huntington's does not mean you cannot get insurance cover. And I think that's what we're aware. One of the myths often is that if you do have that family history or a gene, then suddenly that excludes you. And that isn't the case. There's obviously a nuance to that, which we're going to try and cover today. But I think this is the overall message that we really, really want to get across to you today. Now, before I sort of give you a bit more detail about how we're going to cover and how we're going to spend the rest of the hour, I just thought it'd be worth talking about a quick little story about sort of the origins of insurance, just to sort of really remind you or talk about what insurance is meant to do and where it comes from. I mean, there's a lot of stories about how insurance originated, and and Nicky told me the other day about one from Roman times, which went back much further than even I knew about. But I suppose the one which really talks about the sort of modern day insurance market in the UK is probably best known coming from Lloyd's Coffee House in London in the 17th century. And this is really where sort of sailors, merchants, ship owners all gathered to share and discover reliable shipping news. But also what it did was enable them all to realise and talk about the risks that they're all undertaking when they were undertaking their work, either putting their businesses on the line or themselves as individuals out at sea, and the potential losses that they might be worried about. And what that, I suppose, led to was this idea of the modern day insurance market in Lloyd's, and in the UK, which is this idea that by coming together and pooling everyone's risks and concerns about what they might lose into one pot or one pool, that they could share that risk by paying money in regularly, and this idea that the losses of the few would be paid for by the sort of the premiums of the many. And it's really where that sort of idea comes from. And I suppose the reason to talk about it is because I think in the modern day, particularly when you're buying insurance online, it can feel like it's very much you and the insurer, but actually as an individual buying insurance, you are very much part of a bigger collective of people who are all sharing their risks, and that's really how it works. And we're going to go into that later, and I'll let Nicky as a more of an expert on that than me sort of try to distill that down into relatively simple terms, if that's possible. And in terms of Lloyd's, many of you will have seen it, or if you haven't, if you go to London today, it's Lloyd's market is very much this sort of futuristic looking building with lifts and tubes on the outside. It's a really good piece of architecture, and it's very much where everyone comes together to talk about what was talked about in Lloyd's all those years ago. But obviously there's many new ways and modern ways that insurance is providing you can engage. But I just want to start with that story just to sort of really draw it back into what the purpose of insurance is before we get into it a bit more. And who we are. So my name's Charlie Campbell. I'm a public policy manager at the Association of British Insurers, or the ABI, as we're sort of more often known as. So we are sort of one of the, we're certainly the leading trade organisation for insurers in the UK. And what that means is that we've got sort of lots of insurers who provide all the sort of usual household insurances you might think of. We sort of provide them as a collective, and together we try to be the voice of the industry to government, to regulators, to stakeholders such as the Huntington's Disease Association, but also to sort of try to help our members understand what's going on in that environment. Excuse me. And also with me is Nicky. So Nicky is a member of our genetics working group, which is her sort of principal role for being here today. but she's also, in her day job, she's the chief underwriter at Zurich Insurance Company, who are one of the ABI's members. And just to give you a quick sense of what the genetics working group is, within the ABI and our structure, we have a number of groups of our members who all come together to try to work sort of industry positions which try to improve things for consumers, for government, for businesses, by finding solutions which you wouldn't necessarily be able to find as an individual company, but where you have the sort of ability of the industry to come together for a sort of greater good, if you like, to find answers to various problems. Sorry, I have to excuse my slight dry cough. It's from my child's nursery rather than anything else, in case anyone's wondering. And what we're looking to really cover for the rest of the session, so we just want to go, I suppose, a bit back to basics, if you like, about insurance, what's out there, how it works, and then we also want to talk about, very specifically, about Huntingtons and insurance, which I'm sure you'll all be keen to hear about, and then also touch upon the code on genetic testing and insurance. Sorry. And then talk about what this might sorry. Ooh. Sorry about that. And then talk about what this means for you, and then hopefully at the end we have at least 20 minutes or so just to take any questions you might have. As John said, feel free to sort of, I think, post them in the meantime as they come up, but we'll certainly aim to cover them all off at the end. So in terms of what's out there, you can pretty much get insurance for anything and everything, say, in terms of what you can buy. And I'm sure you've all been there when you've bought a fridge or a washing machine and someone's tried to sell you insurance alongside it as well. But traditionally, I suppose, or more known, will be things like car insurance, phone insurance, maybe not that phone, but a sort of more modern version, pet insurance, phone insurance for your laptop, or certainly cyber insurance, which is quite a new line of industry. Travel insurance as well when you go abroad, and then life insurance and other sort of insurances, which we'll cover in a second, which sort of aim to protect your life and your health. And then also sort of buildings insurance or contents insurance for things inside your home. Those are probably some of the best known ones, but you can get insurance for many other things. And I suppose one of the questions is, do you need to? And what that really comes back to is, I suppose, two answers to that. What do I need to, by law, have insurance for? And what do I want to insure? And those are two quite different things. Sorry about this cough, it's suddenly got a lot worse. In terms of what you actually do need insurance for, there aren't actually that many. And I think that's a bit of a myth. Sometimes people will think you have to have insurance for more, you have to have insurance for more things than you are required to by law. Certainly, probably the two most common known ones are car insurance. So it is a legal requirement to be insured when you're on the road, as I'm sure you know. Public liability is probably the other main one, which people may be less familiar with. So for businesses to be insured against someone making a sort of compensation claim against their business, or potentially an injury which happens at the workplace. And then building insurance, not necessarily a legal requirement as such, but certainly when you take out a new mortgage, you'll often be required to take out building insurance before the mortgage lender will provide you a mortgage. However, although life insurance is often talked about for a mortgage, it isn't mandatory to take out a mortgage. There will be some mortgage companies will often be interested in how you might repay your mortgage should you not be able to work anymore. And life insurance will be one of the things they might ask about, or which might sort of signify that you can repay it. But generally speaking, mortgage lenders do not require you to have life insurance before you can take out a mortgage for a new home or any home. And in terms of our life and health, I think there's a bit of a myth that we sort of come across a lot, which is a lot of people have life insurance or look after health. And actually, one of the things we spend a lot of time in our part of the market is really trying to spread awareness of the need to think about protecting your life and your health. And that doesn't mean trying to sort of sell everyone insurance. What it really means is just trying to get people thinking about, well, actually, if something did happen to me, if I did die, or if I did become very ill and I was unable to work, what would I do? Would I rely on the state? Would the state be able to look after me? And the answer to that is often, well, it depends what your circumstances are. If you have children, if you have assets, if you own a home, what your income is. And for a lot of people, that will not be as much as they might think it is. And I think one of the facts I wanted to draw out here, or two facts, I suppose. The first is that only 28% of people in the country have a life or are covered by a life insurance policy, whether that's something they bought themselves or whether that's something provided to them by their employer. I don't know if that's more than some of you might think, but it'll be interesting to hear what you think about that later. But another one is that actually in the UK, more people are likely to insure their pet than their income. And I think the figures on those, the last set I saw, were almost double. It's about sort of 33% or something of people insuring their pets. And veterinary bills can be very expensive, so no one is necessarily arguing that they shouldn't. But I think what that does is highlight the fact how few people actually do think about taking out cover for to protect against their life and health. And as I mentioned earlier, insurance isn't necessarily the answer, but certainly it does provide a number of different ways to provide peace of mind, which I'm sure why a lot of you have tuned in today. And just to cover a little bit more about some of the broader types of insurance within what we're talking about in terms of protecting your life and your health and your family, there's three broad types, and there are sort of different variations of these. And I think we won't go into those today because we're not sort of advisors, and we can't really sort of start talking about exactly when you should be taking out different types. It's very much dependent on your own personal needs, but also it's probably getting into a level of complexity that we don't need to do for today's purposes. But the three sort of broad areas are life insurance, critical illness insurance, and income protection insurance. And how they work, some of them are a bit simpler than others. So life insurance, I think, is probably the most well-known one. And what that does is you pay a certain amount of money to your insurer per month, and then in the event that you should die for any reason, really, there might be some detail around that, but generally it's pretty clear cut. Then your insurer will pay out a lump sum of money that you've agreed at the start, and generally speaking, the more money you're being insured for, the more that you're paying your monthly premium. And that would be to provide, whether to pay off a mortgage, whether to provide a source of financial income to your dependents, whoever they might be, or whatever you want, really. And then critical illness works in a similar vein, in the sense that it will pay out a lump sum of money, but rather than on death, that will pay out should you be diagnosed with one of the illnesses which is covered by the policy. And again, depending on what you're willing to pay and what you want to be covered for, that could range from the sort of core sort of illnesses which most people might be worried about, such as cancer and heart attack, or it could be a much broader spectrum of different illnesses. And then the third one, which is a little bit different from the other two, is income protection, which rather than paying out a lump sum of money, so say £100,000 in one go, it would pay you a percentage of your monthly income, not necessarily your salary, because lots of people will be self-employed or have different sources of income. And that will be if you are unable to work because of serious illness or injury. So it's less about the specific illness or injury, but what it has done to you in terms of your ability to work. And that could range, those payments could last for 10 years, 20 years, 30 years. It really depends what you want to be covered for. And often with those policies as well, the insurer will provide various services to help you back to work as well, in terms of whether that's physio, cognitive behavioral therapy, or other types of treatment and support. Sorry, you have to excuse this dry cough, which has got a lot worse, but I hope it's not proving too much of a distraction. And it's worth saying at this point as well that, as I think I touched upon earlier, these types of insurances can be provided to you by your employer. So you can buy them yourself, but also very often employers will provide them to their employees, either as something which is free to you as part of your benefits package, or potentially as something that you can choose to contribute to for the cover. And very often the advantage of that is that they don't ask you specific questions about yourself and your own medical histories, which we'll get on to shortly. The disadvantage is that you're only covered by them for as long as you work for that employer, which may be a short time or a long time, depending. And at this point, I'm gonna hand over to Nicky. So hopefully, what I've done there is given a bit of an overview, interspersed by coughs, of sort of what sort of types of insurances are out there, a little bit about sort of types of life insurance, and then I'm now going to ask Nicky to give you a bit of a lowdown, I suppose, on how exactly insurance works, which I'm sure is something you'll be keen to hear about.
Thanks, Charlie. So before I drop into actually talking about what we do and the risk side of this, it might be worth just explaining that my role as an underwriter almost goes back to those coffee houses in the 17th century, where those gentlemen used to gather together and pool premiums and money together to help look after each other if they lost a ship, if it was crossing to the States and got lost in a storm. Each of those gentlemen would write their name under the name of the ship, and hence they became known as underwriters from the name written underneath the risk that they were looking at. So moving on to how does insurance work and how does that then link into what we do to work out the premiums. So the key principles for the insurance industry, it's all based on risk, and we're aiming to offer a fair service based on the risk of any particular customer or applicant. Firstly, we look at the prediction side. So we're trying to predict if or when an event might happen. In some of the other types of insurance, that's trying to predict who might be more at risk of a car accident, or it might be whose house is more at risk of a flood. So you're trying to look backwards almost to predict what might happen in the future. And then the other aspect that Charlie was talking about is the pooling of risks, so that premiums are paid by many people, and then that is used to cover the losses of what we hope are then the few within the community. You can move to the next slide, Charlie. Thank you. So there are two stages to actually determining the cost of the life insurance, and that's at the overall sort of population level that we use to set the sort of standard premium, or our base premium, and then I'll come on to the second stage, which is then to look at the individual customer level. So insurers use information about the whole population to set their rules around the risk pool, and to determine then what the standard cost will be for the majority of customers. And the sorts of things that we look at are the age profile of customers. So how many of the customers may be in their 20s, their 30s, are more of the customers taking out insurance in their 40s, 50s, 60s. So as you get older, your life expectancy will reduce, so the risk of death or critical illness will increase. So we need to look at what's the overall makeup of the insurance population. Then we'll look at general life expectancy at population level, and then down into more specifics for different types of diseases. We also look at overall what is the impact of lifestyle habits, such as what's the impact of smoking on people's life expectancy, what's the impact of drinking alcohol, the levels of alcohol, or recreational drug use. We also look at occupations. Charlie liked this particular picture because it's, you know, a group of skydivers, some holding onto each other, some looking after each other. So the few being looked after by the many, especially if somebody's scared doing their skydiving. But this could be an example of a type of occupation or a hobby where there is a higher risk of death could be involved. And we may look at occupations such as oil rig workers or offshore, and the risks of going backwards and forwards to the oil rig, Formula One drivers. We do see all sorts of strange and unusual occupations and hobbies at times. Hobby side of things, there could be people who decided that they're going to climb Everest for the first time, or we see people coming back and doing extreme sports, each of which will look at the overall risk of doing these types of activities. We also look at previous claims. So what ages were those customers? What were the underlying health conditions? How early did the claim occur in the policies? And then we would then start to look at information specific to you, a customer, to see how that fits with the average results that we've seen from this more population data information. So where do we find this information to set the initial premiums? Charlie, can you move on to the next slide? So it comes from a wide range of sources. Firstly, it will be medical data, medical research papers. We will then use expert opinion from clinicians. A lot of the insurance companies employ their own medical officers who will help and work with the underwriters and with our actuaries, our mathematicians, to help interpret some of the medical research studies. And some of the time that will also include getting expert opinions in from geneticists. This just gives you a couple of pictures, graphs of the type of research papers that we would commonly expect to use. So one of these is looking at the risk associated with people with higher weight, and what happens as people become more obese. The other one is looking at things like trends in life expectancy once somebody has got to age 65, based on the various different diseases. So all these types of research papers and the opinions, as well as market knowledge, and looking at the type of product, whether it's life insurance or critical illness or income protection, all of that is brought together. And then that gives the individual insurer the sort of basis of where they will set their starting premiums. And the insurers have to ask themselves a lot of questions when we look at this data. So was the research statistically credible? We need large studies that have covered a lot of people, a lot of different ages, to be sure that the risks that we're setting is robust and reasonable and fair. We have to look at how relevant it is to the population. So some research studies may be done in other countries. If that country doesn't have the same type of health service as we do, or it has a very different population profile, then those research studies may not be relevant to a UK population. We need to make sure we're interpreting the data correctly, that it's not being skewed by something that hasn't been factored into it, and have changes occurred. So a good example of that, obviously recently with COVID, is that unfortunately we've seen the impact of COVID may have changed the life expectancy of those with diabetes or kidney disease because of the interaction, unfortunately, between the virus and people suffering from specific types of underlying health condition. So all of that has to be taken into account when we're looking at the data to set the pricing. So then the insurers, and particularly in this case, it tends to be the underwriters, medical underwriters, will then look at the individual customer themselves. And each amount that a person will pay for insurance is determined by very similar factors that I'd mentioned before. So starting with your age, whether you smoke, how much alcohol you might drink, other health factors such as your height and weight, whether you have any underlying health conditions yourself, your family history, and then things like what hobbies do you have? Do you go diving? Do you go ice climbing? Do you go flying in small planes? And do you travel anywhere dangerous? So we have to look at, if people are going out to Afghanistan, or if they are going to a country where there could be a higher risk of certain types of diseases. So Ebola would be a classic one, unfortunately, for Africa at the moment, or some of the African countries. Since 2012, we have not differentiated between the gender. So males and females pay exactly the same price for life insurance as each other. So we don't take into account gender when determining the premium anymore. So insurers want to be able to provide competitive prices, but also to provide acceptance to the vast majority of customers. This keeps the insurer in business and is effectively a public good as well by providing this safety net should the worst happen to as many people as we can. However, when we go back to the principle of the premiums of the many are there to support the claims for the few, if there are customers who are presenting a higher risk, then they may have to pay more to balance out that risk pool and to make sure that we can still stay competitive. Insurers' standard rates, the base premiums, will reflect the mortality of the people who take out insurance, and that does tend to be a population that's fitter than average. Some of that will be due to the fact that people who are very unwell, very ill, are not likely to be considering taking out life insurance. Anyway, you'll also have people at the very, very low income level who, again, may not be in the sort of insurance population. So although we can't provide cover to everybody, what we do try and do is widen cover and offer terms where possible, even if that's with a higher rating. And if I go on to the next slide, I should show you how the effect of a rating correlates with life expectancy. So on the previous slide, we've just shown that there were a range. So for many of the products, you would go from what we would deem to be a small rating of a plus 25 to plus 50 extra mortality or extra rating, up to a maximum acceptance for most companies is around a plus 400%. And what this means, these charts show an example of population data for life expectancy, and it calculates the risk of dying in each year, each subsequent year, from a person starting at age 45. So the age is shown along the bottom axis of both of these graphs, and then the y-axis running up the side shows the percentage of people in the group that are still alive at each of those age ranges. So the one at the top is effectively 100%. So what we're showing is that if you start with two 45-year-olds, one of whom who has no underlying health conditions, and therefore what we would deem standard rates, and one who has underlying health condition or risk factors that mean that they are plus 100% higher risk, or effectively twice as likely to die in each year, you see the curve as the number of people dying at each age reduces down who is actually left alive at the next age group. So for 45-year-olds, the effect of a plus 100% rating or expectancy that's twice what a standard person would be, would reduce their life expectancy on average from around 80 down to a average life expectancy of around 73. For somebody who has a rating or a higher loading of plus 250%, then that extra expectation of dying at each age reduces their average life expectancy from around 80 down to an average of around 67. We are using averages all of the time when we're looking at insurance risk and pooling. So some people would obviously still live longer, but unfortunately some will die earlier. And when we're looking at the insurance, we're pooling these to determine the premiums and the ratings. And as mentioned, the standard rates is reflective of a group of the population that's fitter than average. So when we then compare some of those medical research studies that I was talking about, where we're looking at a higher risk, say somebody with obesity could be a plus 25% higher loading, we're having to look at how that compares with our insurance population. So plus 25% against a UK average population may be more than plus 25% when we compare it against a extra healthy insurance population. So when we look at Huntington's disease, this shows just one study that looked at the average life expectancy of those who have been diagnosed and suffering from Huntington's disease, and looked at the life expectancy and whether that had changed, particularly over the last few decades. There have been similar studies done in different countries, including in the UK, and they're all still showing very similar results at the moment, where the age at death of people with Huntington's has tended to be around 13 years lower than in the general population. So that when we equate it to additional mortality risk, although against population that would be around plus 450% higher against population, that tends to end up around 800% or higher when compared against insured insurance customers. Hence, most insurers currently would be unable to offer insurance to somebody already diagnosed with HD or already suffering from HD. However, if we go on to the next slide, thank you. Individuals who have a risk of Huntington's due to the family history can be offered life insurance, although it would be with a loading, and that loading is reflective of the 50-50 chance that somebody with a family history, direct family history, could have inherited the Huntington's mutation themselves and therefore be at future risk of Huntington's. And of course, Charlie will come on to later about the genetic tests and the fact that we will not ask for genetic tests. So we're only using the family history information. So at a young age, we don't yet know whether the customer would fall into the 50% who may have inherited the mutation or the 50% who won't. Hence, you've got quite a high rating to start with, but as the person gets older, if no signs or symptoms of Huntington's have appeared and no diagnosis made, then it switches to become, the probability is that the person has not inherited the mutation, therefore is likely not to go on and get the disease, and therefore the ratings start to drop. And by the time you get into the older ages, there may be no rating at all. Because of the costs of life insurance and this way of pooling as many people as possible to help look after the claims, life insurance particularly these days is relatively cheap. So for a young person with a family history only of Huntington's, even though a plus 300% loading, which is effectively 4 times the premium, sounds a lot, you could still find that you're able to purchase 100,000, possibly more, of life insurance for under 20-25 pounds per month. And some cover can be better than no cover at all if you're looking to protect future dependents. So going back to things like a future mortgage. And if a customer is clear about how much you want to spend or are able to spend, rather than actually how much life insurance you want or need, then there are advisors out there who'd be able to look at, well, if you wanted to only spend £20, what would that mean in terms of how much life insurance you could purchase? I'll now pass back to Charlie.
So thank you, Nicky. And I think my little coughing fit's passed now, so I hope that's the end of that and no more distractions. What I just wanted to talk about here for the sort of final few slides before we sort of open it up for some time for questions, I suppose was just a little bit about the sort of the regulatory environment, the code on genetic testing, which we talked about, but also just a bit about this point about insurers needing to know what you know, and why that sort of feeds into something we call anti-selection, which I'll explain about in a second. But what this really comes back to is what we call the sort of information asymmetry. So for insurers to really know and be able to accurately predict what's in their sort of wider risk pool, they need to know the information that you know about yourself in the main. So it's really important that when an insurer does ask you a question about your health or your family history, that you answer it to the best of your ability. And I think that does sometimes, that phrase can often cause a bit of alarm because some people are worried about how accurate they can say it, or what they can recollect, or if they do know everything about the family history. But those questions are very much around what you do know and answering to the best of your ability. And if something does crop up, an insurer may well ask for your consent if they can go and ask your GP to have a look at your medical records so they can get a clearer picture. And I sort of just put a bit of a stat at the bottom there, which is that 98% of claims for sort of life, critical illness and income protection were paid in 2020. And I think that's, generally speaking, that's a lot higher than people think. And a lot of people will see stories where insurers have dodged claims not paid out. And without sort of commenting on every specific case and the merits there, I mean, one of the reasons, or certainly the top reason that the claim isn't paid is often to do with what we call non-disclosure. So when someone has withheld information about their health risk, and most of the time that would be through trying to avoid telling it as opposed to inadvertently. Sort of insurance applications are generally set up and with that sort of ability to go and talk to a doctor to make sure that that you are telling questions to your best of your ability, but also to sort of reduce the chances that it's an accident. So it's really important that people or applicants do share what's asked for them by the insurer. And the reason for this is because if insurers end up seeing a large amount of what we call non-disclosure, and that sort of anti-selection potentially where people are buying insurance without and purposely not telling the insurer about information, and insurers then see a lot more claims than they were expecting, that can make them more cautious. Which might mean that could lead to higher prices to sort of avoid the impact of more claims, or it could lead to them not offering insurance to some of the people at higher risk because they want to sort of control their risk pool better. So moving us on to the next slide. I mentioned that insurance is a highly regulated industry, and I've just drawn out here a few of the bodies that are sort of involved within that. And what we mean by that, I mean, there's a lot of sectors and industries that I'm sure a lot of you work in or are familiar with, which are highly regulated. Sort of financial services, and particularly insurance, is one of those. And in many ways, that should offer a lot of comfort to you and to customers in terms of around the rules which insurers have to abide by, because it's an incredibly complex product, as I think Nicky's hopefully tried to demystify a bit, but also illustrated. So a lot of these bodies do try to work to sort of set those rules, which makes it easier for customers to understand insurance. So the FCA, or the Financial Conduct Authority, is one that we spend a lot of time working with, who will set various rules and ensuring that insurers can treat sort of customers fairly, make sure that their communications are as simple as possible, because very often trying to understand a policy document, as I'm sure you've seen in terms and conditions, is a nightmare. So there are various rules to try to make that simpler and easier to understand, which is consistent across the industry. Another one is the Prudential Regulation Authority, or the PRA, which sits in the Bank of England, and that's very much around making sure that insurers have enough financial capital or money in order to pay any claims that they come in. So sorry, to make sure that they do have enough funds that if a large amount of claims do come in, they can see it. And you would have, you'll certainly in the Lloyd's of London market, for instance, if there are sort of hurricanes in the US, you'll see suddenly insurers potentially incurring a huge amount of claims in the millions. And so this is really about making sure that they do actually have the funds in the bank to be able to pay those claims when those occurrences do happen. Two other bodies of interest. One at the bottom is the Information Commissioner, or the ICO, as I put there, and that's very much around beyond insurance and financial services, but it's really much regulating how insurers and others will use your data, making sure that they're asking for consent and that people understand what data is being used about them, how it's being held, and what your rights as a consumer are, to make sure that someone, an insurer or any other organization, has to sort of delete your data if you ask for it. And then the top right one is one which you may be aware of, but I think it's a really important one to be aware of. It's the Financial Ombudsman Service. So very much looking at any complaints made against insurers or other financial service firms, to sort of see if they have been treated fairly, whether the terms of a insurance policy have been adhered to by the insurer when a claim is made. And so they'll sort of arbitrate to make a decision about whether a claim should or shouldn't have been paid. So we will, I don't think we put the contact details in here, but if you Google the Financial Ombudsman Service, they're a good source to go to if you ever are making a claim and having raised it with, if you feel like the decision an insurer has made or like turned down your claim, for instance, if you sort of argued it with the insurer and you're unhappy with that, then you can go to the Financial Ombudsman Service. You can make a complaint through them and they'll take it up on your behalf. So a really, really good service to make sure that businesses are sort of following the and providing cover as they should. Apologies. The next one, coming towards the last couple of slides, just a quick bit about the Code on Genetic Testing Insurance. It used to be called the Concordant Moratorium on Genetic Testing Insurance, which was a real tongue twister. So the Code on Genetic Testing Insurance is a better name, if not still long. I just wanted to draw out a couple of points in here, and there's one which I haven't put on here, which I just remembered as Nicky was talking. It's a really important one, which I'm going to draw out in a second as well. But in the sort of simplest possible terms, this is what we call a self-regulatory agreement. So this isn't law, but it's an agreement between the ABI on behalf of insurers and the government, specifically the Department of Health, about how insurers will use genetic information in underwriting. And that sort of started about 20 years ago, and it really came from a concern that patients within the NHS may be reluctant to take a genetic test which could help their diagnostic pathway, because they were worried about whether they might be able to get life insurance if they did have an adverse gene which could sort of make them a higher risk. And the insurance industry has essentially agreed not to use a predictive test, so when someone's asymptomatic, but would use diagnostic tests only, which was sort of in keeping with a number of the other pieces of health information like family history that they already used. And then within that framework, it set a few financial limits. So £500,000 for life insurance, £300,000 for critical illness insurance. Sorry. And the theory was that any policy, or if you're applying for insurance cover below those limits, you'd never have to disclose a predictive test result whilst this agreement was in place, but that the industry could apply for certain conditions to be exempt above those limits. And so currently the only one is for Huntington's disease, which is why often there is a bit of a focus. And that was the first one which was applied for, and the industry hasn't yet applied for other ones. And what that really means is that if you're applying for more than £500,000 of life insurance, and you have had I'm moving around a bit. You have had a gene for Huntington's, a predicted gene for Huntington's, you would have to tell your insurer about it. If you were applying for less than 500,000, you would not have to provide that. You would still have to tell them about family history, but you wouldn't have to share that predictive result. And if you did inadvertently tell them about that result, they would have to ignore it. And we collect data on that to make sure that insurers are abiding by this agreement. Now, one actually really important, and what I put out at the bottom there as well, is that what this means is that in effect, around 95% of policies, you do not have to disclose any predictive gene to an insurer. And it's only those 5% of the most expensive where you would have to. But actually, one really good part of this as well from a customer point of view is that for you in your community, is that if you do have a history of Huntington's, but you have had a test and it shows that you don't have the gene, you can tell your insurer about that, and they will use that to offset your family history and potentially give you more favorable terms. So they might reduce that rating that Nicky's talked about earlier. So it's a really important thing to be aware of and to know about. And I apologize, I didn't put it on slides, but if we do circulate this deck around, I will try to add that in so it's really clear. I will stop there on that, but there may be further questions on that later. And I'm just going to finish up our part of the presentation with what this means for you. And I think a key message here is that no doesn't mean no. So just because one insurer might say they can't offer you terms for insurance doesn't mean another one will. So as sort of really Nicky's shown as well, insurers will have sort of those different risk pools, which means they'll have different appetites for who they can offer insurance to. So it's very easy for people to sort of be turned down by one insurer or be offered very expensive premiums to then think that means no one's going to offer it to them. So it is always worth what we call sort of shopping around, but that can be hard and time consuming. So we've provided a couple of links here of some places you can go to try to find people who might be able to offer cover. And financial advisors often specialize in helping people who are at higher risk find cover. And these are good sources to go to. Money Saving Expert gives a really good overview of the types of cover out there, but unbiased.co.uk and called biba.org.uk, so it's the British Insurance Brokers Association, both offer services which can help put you in touch with someone who can help find information. We'll stop there. I hope that's covered everything off, and hopefully we've sort of achieved our aim, which is to really explain that a little bit about how insurance works, what's available, but also that with a sort of family history or a gene for Huntington's doesn't mean that you're excluded from getting insurance, and that you can do it. There are things to think about, but it should certainly be something you can think about doing.